I've been watching their videos for a little while now and have a little crush on someone named... Hey guys, my name is Ryan, and with all the craziness going on in the market right now, there's one thing that everyone is wondering. Is the stock market about to crash? Believe it or not, I actually don't care that much if the stock market crashes or not, because I've realized some things that I shouldn't be afraid of, and I want to share them with you too. You hear it all the time where people see a dip in the market and immediately start selling off their investments, but that's not necessarily the best strategy that you should take. While obviously you're not going to have a beaming smile on your face if you see your portfolio in the red, we're going to talk about what you can do to stay sane and come out profitable. It's natural for the stock market to go up and down, but I want to help you be confident enough to weather out any storm. So in this video, we're going to be talking about the one thing that almost always predicts stock market performance and the 3 strategies that you need to do to come out ahead regardless of a crash or not. But I hope that your mouse comes crashing down on the like button and subscribe button, because I would really appreciate it and it really helps me and my channel out with the YouTube algorithm. If you're new here, I make new videos on personal finance, investing, and bad jokes, so please join me for some new content every week. So right now we're in September, but the big question that everyone's wondering is if the stock market's going to crash later this month, in October, in November, or in 2020. Despite everything going on, people are still wondering why the stock market and the S&P 500 are still so high and are trading at levels pre-illness. The stock market is not the same as the economy because the stock market is ultimately driven by speculation. We see this all the time in the news and the media covering stock splits and earnings reports, and just the slightest bit of news can send the market up or down. It's really easy for people to feel FOMO, and hype and speculation can really affect investors' decisions. But because the stock market is driven by speculation, it's really hard for people to predict what's going to happen next. Over the years, many famous economists have made predictions about what the stock market's going to do, but most of them do not come true. People have been saying since 2013 that the stock market's going to crash, but we've been in a pretty strong bull run, so none of those were super accurate. But watch this video until the end to learn what you can do even if the stock market does crash. But this just proves that we cannot give a definitive answer of when the stock market's going to crash. However, there's an important thing that almost always predicts stock market performance. This one indicator holds the stock market together, and that one thing is interest rates. But a quick disclaimer is that I'm not a financial advisor or a financial professional in any means. I'm just a guy on YouTube, and these are my opinions for entertainment purposes only, not financial advice. As legendary investor Warren Buffett says, the most important item over time in valuation is obviously interest rates. Warren Buffett also says that everything is measured against interest rates because they act as a kind of gravity on valuation. If interest rates are high, then there's a lot of gravity to hold things into place, but if interest rates are low, then there's no gravity to hold down the stock market. And so far in 2020, there's been a big cut in interest rates, which explains why the stock market has gone up so much. And currently, today in terms of interest rates, we're at an all-time low. But please watch until the end of this video to find out why that might not be a good thing. But low interest rates are so attractive because it lets businesses and people borrow money, use that money to invest, which in turn puts more money back into the market. You can think of this like your credit card cutting interest rates on anything that you don't pay off at the end of the month. It's essentially getting free money and swiping on whatever you want. But if interest rates go back up, people will be less inclined to borrow money and invest in the stock market because there will be more gravity. But as of recent, we've been seeing rock bottom interest rates, which is usually a good sign for the market, but the market has been falling. So what's the deal? This brings us to the first strategy of coming out ahead, which is stop trying to time the market. You should not be believing that something should happen just because the economy or a famous economy says that it should. Trying to time the market is horribly inefficient, and we've been proven time and time again that we can almost never predict what happens. The stock market is also not a reflection of the current economy, and keep in mind that there are a lot of things that have happened this year that have affected the economy as a whole. This year, we've received the largest stimulus package in history, and also the largest amount of stimulus check YouTube videos to go along with it. Unemployment has also shot up this year, and it's never gone up so high and so quickly before. And if unemployment stays high, then the economy will inevitably go down because less people working means less output than what it was before. With all these different factors affecting performance, we really can't time the market, and the best course of action is to stay the course, stay invested, and continue investing like normal. This might sound counterintuitive, but as long as you're diversified and you're invested in good companies, then the best thing that you can do is, well, nothing. But actually one thing that you can do is to smash that like button and keep watching this video. This filming session is currently being fueled by Ito and Golden Oolong Tea. If you know, you know. The second strategy to come out ahead is to stop buying and selling on impulse. If you're trying to time everything down to a week-by-week schedule, or you're following what the media says, don't expect to make a short-term profit. But I get it, and it's really easy to feel the FOMO and get caught up in the hype and the speculation that all the news and media are saying. However, if you buy and sell on impulse, then you're making decisions based on emotion instead of logic, and that can be a really slippery slope, just like when you decide to call your ex at 3 in the morning. But the best way to combat buying and selling on impulse is to slowly buy in, and by doing this, you are guaranteed to get close enough to a dip, which is all that matters in the long term if you're averaging in. As weird as it sounds, the best thing that you can do is to invest consistently and then do nothing for a long time. Just set it and forget it. This is because the fundamentals of long-term investing work. Buy, hold long-term, stay diversified, and you will profit in the long run, even if you're doing this and you're buying at all-time highs. Now, I've never mentioned this before, but there's another YouTuber that I kinda fancy because I really like their content. We've talked a few times on Instagram, and I really like how honest their stuff is. I've been watching their videos for a little while now, and I have a little crush on someone named Graham Stephan. Everyone watching this is probably like, wow, that was the worst build-up ever. But speaking of him, one quote from Graham Stephan is, every single time the S&P 500 has hit an all-time high, it's hit another all-time high 100% of the time at some point in the future. With this in mind, not being impulsive and being consistent instead will give you the best chance at making money in the long term. But don't forget to watch until the end of this video for the most important tip. Even if the stock market and the S&P 500 hit an all-time high, there will always be another all-time high sometime in the future, so the best bet is to just average in and just wait it out. Invest consistently no matter what, and don't get swayed by hype and speculation by the news. You should never invest emotionally because that's essentially gambling your money away, but instead, you should be ready to hold whatever investment you buy today for the long run, regardless of whatever happens. The third strategy that you can do to come out ahead is to stop waiting to invest. A lot of people will watch the stock market and sit around waiting for a crash that may never happen. The problem is that if you keep on waiting and waiting, you miss out on a lot of great opportunities that your money can work for you. And there are a lot of people that try to buy the dip and sell at the peak for maximum profit. But for the majority of people like me and you, investing a consistent amount of money every week or every month and not thinking about it will be the best long-term strategy. The market is irrational, and nobody knows when or if it's gonna crash. Me trying to predict a crash is like me betting all my money on red at Vegas. If you have a stable job and you've saved up a 6-month emergency fund, one, you are very fortunate, but you should capitalize on that. Stay the course and continue buying and holding. Returns might be slow, and they probably will be for a little while, but they should be fine in the end, and we have history to back us up too. As we can see, throughout any recession or any crash, the stock market has always recovered and has gone up in the long term. I'm young, so I can definitely wait it out long term because patience pays and I have time. The stock market changes all the time, but that doesn't change the investing strategies that have continued to work long term. Don't try to time the market, but instead buy, hold, keep on buying, and invest consistently with the mindset that nobody knows what the market's gonna do. If you do this consistently over the long term, and you pick good companies and broad indexes, you will almost always come out profitable in the end. It's said that looking at the unemployment rate is a good indicator of how the economy will move, but looking at interest rates is a good indicator of where the market will go. While we're experiencing some rock bottom interest rates right now, we shouldn't be changing up our investing strategies. Investing consistently regardless of what the market is doing will help you come out ahead in the long run, and I think that's all that matters in the end. But I hope this video was helpful in explaining how interest rates affect the market and how you can still be profitable in a crashing stock market. If you enjoyed this video, please smash that like button because it really helps me out and it lets YouTube know that people appreciate content like this. Please subscribe to my channel if you want to see more videos on personal finance and investing in the future too. Please leave a comment down below if you had any questions or let me know what you think the stock market's going to do for the rest of the year. But speaking of investing, if you want 2 free stocks with one of them valued up to $1,400, click the link down below for Webull. If you're interested in fractional shares and getting a free $20, then click the link down below for M1 Finance. Thank you so much for watching and make sure you stay financially fashionable.